Tuesday, 17th of August 2021 here in Geneva. Today I'm joined by Jabir Sardharwalla, who's the Group Chief Investment Strategist at Skybound Capital. Jabir, very good to be with you today.
Thank you, Will. Yeah, it's good to be here.
I'd like to start today, if we can, with our old friend inflation. Now, I know we've seen inflation. Today our topic is, just to briefly introduce it, is the role of commodities within the macroeconomy and within the investment world. I think commodities and inflation is always an interesting match, and we've seen inflation come back in the last few months, over 5% in the US, 2.5% the UK, Eurozone above 2%, Brazil even is plus 8% in some respects.
Yeah.
And I think what's been interesting, looking at the main commodities, gold and silver typically, we saw their prices rise throughout 2020.
Yeah.
And then we've seen them really trailing off in 2021 and the past few months. And I guess what I'd be interested to know your thoughts around is to what extent are commodities such as gold and silver, to what extent are they a genuine hedge, having seen their prices decline now that at the same time as inflation is becoming an issue?
Yeah.
And to what extent were they more a way of hedging just general uncertainty in the economy?
Yeah, definitely. No, it's a great question, and it's a debate that's gone on for years. I mean, for as long as I can remember, and I've been a gold bear for most of the last few years, and I still am, just less so. And I think the thing to remember with gold is that it serves two functions. I mean, and I'm not going to get into the jewelry side. I'm just sticking on the economic side.
Yeah.
It serves two functions. The first is that unless you really feel that there is no viable currency that one can trade, that one can have one's assets stored in, as a measure of wealth and so on, all the usual definitions of a currency.
Yeah.
Then gold and the like, for instance, silver too, come into play, because that's when you get that inevitable scramble for something, for that the ultimate safe haven. Never quite figured out how you would trade in, barter or trade in gold bars, but that's a wholly separate issue. The other reason for gold is if you get inflation that gets out of control. And then suddenly it's a case of, well, the money you hold is probably eroding by the second. How do you preserve your wealth? And we're not there yet. In fact, we're not there on both fronts. The world's unit of exchange remains predominantly the US dollar, and frankly, it's doing a fine job. I mean, well over 70% of all transactions are taking place in dollars, and I don't see anything that's going to upset that.
But just on that, Jabir, because obviously prices of financial instruments don't just reflect what's happening today; they reflect about expectations of the future.
That's right.
So could it also be expectations around, yes, we're not seeing significant inflation today, but there is, call it maybe a tail risk for some, it may be a broader risk for others, but that risk may come at some point.
Yes.
And it's best to be prepared rather than plowing into commodities right at the moment that suddenly a currency loses its values. It's better to have hedged in advance, if you see what I mean.
Definitely, absolutely. And what I would say there is, I mean, this comes back to the good old-fashioned asset allocation approach, right? So if you want to hedge, then the sort of questions you have to ask yourself is, first of all, what your patience level is. How much are you willing to bear in terms of cost of carry? Because after all, gold doesn't pay anything. That's just the reality of it. So with those two questions, for instance, it really does test your ability to hold on to something which is likely to not perform for you and therefore be a significant drag in your portfolio. And that's what we've been seeing with gold. Now, there are other factors at play here. For instance, the rising negative real rates, which is obviously another big issue. So initially what we had was when nominal yields were going up, If you recall, that's when gold started to act more favorably, but not now. I mean, it's suddenly then plummeted. It's gone the other way. And that's because I think from a portfolio perspective, you have to take into account what's going on in terms of policy matters at central bank level. Central banks have made it clear that they're not budging on the front end rates. They've made it quite clear. This is now an all-out play on the unemployment market, and they want to get that back to a level that makes them feel comfortable. Only then will they start to move. So I think portfolio managers who are holding gold in anticipation of a future event, whatever that may be, and we get into the realms of known unknowns, unknown unknowns, and so on and so on, I think that's a dangerous strategy, because we just don't have a time span on it. If you're worried about what tomorrow might bring, the unexpected, then frankly, you're better off buying puts on a major index. Yes, there's a cost there, there's a theta, but weigh that up against what you can afford to lose versus what you can make on the opposite side of the book. I personally think that's a better way. And then if it's not going to your way, you can always trade out of it. But it's a quicker route. I think there are too many dynamics that go into gold, which affect that are not synchronized with portfolio management. So you then mention in the wider commodity context what happens, because of course it's a commodity. I totally appreciate it, and this is where you have to be discerning. You've got to break it down. So you have the energy component, you have the precious metals component, and then you have the metals, the agri, and so on. And here you have to take a view on growth, I think, because if you believe in growth, there are many different ways of playing the markets. But if you are also worried about the inflation side, then you have to ask yourself, who has pricing power in all of this? And that's one of the best arguments for commodities in the categories that I just mentioned, particularly around energy, which is directly linked to growth. And actually, in fairness, energy has held up pretty well. Even when we've had this tail off with the Delta variant, we had those natural disasters, tragic disasters, floods in Germany and China and so on. Throughout this, the energy complex has held up quite well. It's always bounced back to a comfort level. Outside of that, I think growth also implies good prospects for the wider metals industry. Now, I totally understand that lately those areas have fallen off quite considerably. Copper's come off about 10%, iron ore about 20-25%. Lumber's really taken a hammering, having gone up over 300% at one point. So there is that growth dependency play here. There is that correlation. Therefore, if you're looking for a portfolio where you are hedged for a possible fall in growth, commodities is not going to help you, or it's potentially damaging.
Yes.
But if it's inflation specifically, I think it's one of the best asset classes, particularly given what's happening in the world today, to actually give you some protection in the form of pricing power.
Because ultimately as well, a lot of the inflation figures are being driven by underlying energy costs.
Absolutely.
When you break out the inflation figures for the US, for example, and you look how much is food, how much is energy, how much is other factors, it's the energy that's driving the headline figures.
Absolutely.
Food may have risen sort of almost 5%, but energy, in some cases, it's sort of 40% plus.
Definitely, yeah. And Will, that's what worries me, because in that there's almost a certain path to the rise of inflation. And invariably, it begins with energy. That's almost, if you were drawing a pyramid, you could start with energy at the bottom first. So any turnaround situation. And that's exactly what we're seeing. And I always just like to sort of follow the commentary that comes out. So you have to give it a bit of time and just monitor it over a few months. But semantics are very important here. And we've gone from, oh, this will be short-lived, This is just energy correcting itself
Yes.
to energy prices don't seem to be settling down as quickly as we expected.
Yeah.
So there's obviously some juice left in that sector. And incidentally, I think it's quite feasible that oil will settle in somewhere between 80 and 90. That's my feeling in terms of a balanced arena, even with more production to come. That's where we'll be.
It reminds me your point on semantics a little bit around the unconventional monetary policy suite available for central banks. One of them being what was wonderfully called forward guidance, which I think is this idea of essentially talking to the markets and trying to woo them in a particular direction.
Exactly.
Essentially by anchoring future expectations. So I think it's interesting that as the words of central bankers are picked apart by analysts and investors and so forth, having to pay quite careful attention to the specific languages they use to then be able to interpret actually what they're really thinking, I think is interesting.
Definitely. And another one, incidentally, is central banks now saying inflation will be higher and transitory for longer.
Yes.
Whatever that means.
Transitory
that
for longer,
like
I think is
correct.
Yeah.
I think they're really hedging their bets there now. It's almost an acknowledgement that no, we realize this is going to be a sticky problem for much longer. But they're not shifting.
And just to sort of play devil's advocate a little bit, because I know wind back the years a little bit to 2008, 2009, we saw a big fall off in demand. We saw an initial drop to inflation, followed by a subsequent rise in inflation. I remember back in the UK, we had sort of 4 or 5% around about that time, which hit the currency. Happened to be traveling in New Zealand at that time, and I remember the value of the pound-dollar exchange rate depreciating very unfavorably. For my travels down there. But what we then had after that was a lot of people talking monetary policy coming through. We'll have a little bit of deficit spending, but there's a risk that we're going to have too much inflation. Actually, the risk then became to the downside. And we were then at risk of very much deflation, secular stagnation, and so on and so forth. Do you think that risk still applies in today's context? Or do you think the policies that are currently in place, Biden's stimulus bill and so forth, are actually going to break us out of the risk of deflation?
That's, that's a key question perhaps for a little bit later in the economic cycle, but it's certainly one that you have to think about now. And it is a definite risk. I mean, for instance, I'm now another thing I like to do is just to see what sort of headlines are coming out. It's almost like, Googling and seeing what people have been tapping in. And I'm now starting to see headlines around stagflation. So that's an interesting one. I think it could be an issue. I really do. I think it could be an issue. But first, they've got to clear the inflation milestone first. Because if inflation can be contained within an acceptable range, my view is that it will settle for a long time in the 3 or 4 to 6% range. And I think that's where we are.
Are you talking global inflation, or are you talking specific regions?
It's always going to be specific, but I mean, I think generally it will be applied. I think that from the supply side, which is mostly, I mean, this is a generalization, but it's mostly EM world. And then from the consumption side, obviously you've got DM world. And those inflation numbers you read out, I mean, they're already high. In the US, they're running at headline well over 5%. Even the core, this is worrying. The core is proving to be stickier and stickier. And in the US again, and one has to, one always comes back to the US because it is the world's biggest consumer market. There it's over 4%. I just saw this morning a headline that even in India, core inflation is proving to be challenging. So they're feeling it in emerging market countries more because food is a much bigger component of their baskets. Much bigger. It's like 35 to 40%, whereas for us it's 15 to 20%. So I think they've got to get through the inflation milestone first. If they can tame it, as in control it, then we're looking at growth with controlled inflation. in that range. I do believe it will be, you know, a higher, it will be higher than what we've experienced thus far. However, if it turns out that they've made a policy error here and they think, damn, we need to apply some brakes, well, there's only one mechanism they can use, and that's interest rates.
Yep.
And if you start ramping up on interest rates, then you tip the economy very quickly. Everywhere people feel it. The yields, the bond yield market, works quite independently of central banks, as you know, we both know, and that will react quite viciously. At the moment, the Fed's done a pretty good job of talking things down. And on top of that, world events, I mean, particularly, for instance, the data that's just come out of China, together with, you know, all the weather-related issues and Delta variant and so on and so on, and their own COVID situation, that's helped to talk yields down again. Yep. But left alone, yields will rise. And if the market,
presumably they will rise based on expectations of future rises.
Yes.
So if you start to see inflation being stickier, start to hang around a little bit, then people start talking, as we found at the start of the year, people start talking about future interest rate rises coming and maybe coming sooner than previously expected, which then leads to yields rising and so on and so forth. And in the context of commodities, if you see the Federal Reserve raise interest rates, presumably what you will then see is then an appreciation of the dollar as you get capital inflows into the US market, which itself will then have the inverse impact on commodity prices. And so we're almost sort of going back. So that would then bring inflation down and so forth, which would then be better for the dollar because it's not reducing the value of the dollar and so on and so forth. So can you see a situation where it sounds almost strange when we've had no interest rate rises, really decent interest rate rises for many, many years, but can you see a situation where inflation does get to that point where central banks are forced to ultimately increase interest rates rather than just slowly incrementally increase because the economy is bubbling along nicely?
I can, but I think there are a couple of things that are very different here at play as well. So first of all, we saw it in the Trump era, and that is the world is de-globalizing to a certain extent. Just how far it goes, we'll have to see. But we saw it during COVID, and we've seen it even more since with the silicon chip shortages. It's really affected car manufacturers. And I think there will be a growing push now. I mean, there is a growing push to bring certain forms of production back home. I think that is absolutely definite. You know, so what constitutes critical is being re-looked at. So a lot more manufacturing will come home, aided by technology too. You're going to see, you know, robotic factories as far as one possibly can. Look at the whole vaccine story and what was labeled as vaccine nationalism. Particularly, you know, with the way certain components of vaccines were manufactured in Europe. So Europe thought, okay, great, I've got some leverage here. I'm going to use that as a kind of stranglehold. You know, next time round, we have a situation like this, and countries will be making sure they're manufacturing their own vaccines fully at home. So that's one key change that's taking place. The second thing is that there is a concerted push towards green everything. So I'm going to call it go green. But, you know, we've seen, you've probably seen how the Senate Democrats have, amongst themselves at least, approved their own bill for $3.5 trillion worth of spending. Now, obviously, that's got to go through Congress in the formal way. It will take a few months. But something will come out of it. We know that, and it will certainly have at least a 1 trillion number in front of it. This is significant now. You know, I think given what's happening on the planet side of life and global warming, people are not going to let up here. And within that, you can drill down even further. I mean, take electric vehicles and so on. So you've got this commodity demand pull that's going on, which is huge. It's really significant. So yes, ordinarily what would have happened in the past is that dollar rises, that brings down inflationary pressures, which it will still to a certain extent. But I think more than compensating that, I think you'll see more production coming back home. Plus the themes that I just mentioned, helping to drive commodities up. So I don't think you'll immediately see an overall decline in commodity prices, but eventually it will get to a balance. But I don't see that on the horizon just yet.
And there's still an interesting subsidiary point there, which is even if you bring all manufacturing back home and you're assembling the parts in a factory in Massachusetts or wherever it might be in the US or in France or in the UK accordingly, you will still need to be sourcing your underlying raw materials from somewhere.
Exactly.
And then the interesting question from an economic and from a political perspective becomes, where are these components coming from? What are the regions of the world that we need these underlying substances and these underlying commodities? And that's when the question turns around to emerging markets. And bringing around to that point around, well, there's obviously certain interesting factors there.
Definitely
worth thinking about, but also that question of growth. And if suddenly the developed world starts demanding significant commodities from the emerging world, will that then bring up the emerging markets themselves?
Absolutely. And emerging markets still dominate by and large. They still dominate the supply side. I mean, that's just the reality. Obviously thrown into there, you've got countries like Australia, for instance, but predominantly emerging markets, really dominate this. So that's going to be a big boost for their economies, which means that those that have sizable populations can use those proceeds to actually encourage more consumer-driven growth. At the end of the day, the US is the envy of the world insofar as its GDP. When you analyze the GDP component, 70% is household consumption driven. If you throw in government consumption, it's 80%. Okay, so the rest is there just to serve a huge, voracious appetite. That's what it is. But it's actually a very enviable position to be in. And that's what the EM world is striving for. I mean, it's one of the critical differences between EM, by definition, between EM and DM. It's, who is a more consumer-oriented economy. So the world of EM still has plenty of room for growth. And as it grows, what happens to commodities, which are, we know they are finite. I mean, it's just, there are limited amounts. So unless science changes things, they're going to be in a very powerful position. So I think we've only just seen the beginning of what had been quite significant commodity price rises. I think the recent fallback is temporary. It's quite temporary. And I do believe when things settle, they will resume their upward path.
Which brings us round to the final point I just wanted to pick your brains on, which is this idea of a commodity supercycle. And whether we are now at the beginning of such a supercycle and how long that might last and so on.
Yeah, definitely.
Do you see that starting to develop yourself?
I do. I mean, I think as long as we're just at the beginning of go green, and the rest of the world then starts to catch on. We know Europe's taking this very seriously, and I'm starting to see it also in the UK. I think this is very significant, and as a result, I mean, we're not going to fix this problem overnight. We're just not. Even if by some bizarre method we could get harmful emissions down to where we want them to right now, we've still got the issue of how do you live in an environment where temperatures are higher than what we've known them to be. So they've still got to address that issue. So I think as long as money is thrown at this problem, and sadly there will be a lot of wastage, That's what happens when you have fraud, you have waste, you have all kinds of things. But overall, there will be more good than bad. I think this is a big pull. Let's not forget also, the size of the world's population. And also the fact, I think there are other things at play here. So for instance, one thing that's happened in COVID, very simple example. When Amazon reported its results just recently, they gave a caution. They said that, don't expect this to be the same going forward. And I thought to myself, why? Because what we've become used to during COVID is that remarkable ease of being able to go onto the app and ordering really quite sort of trivial items, because we don't have to go out of the house and waste time and buy it at a supermarket. Now it's just delivered to you the next day. So it's such a comfortable way of doing things. What that's done, first of all, why would you want to change it? And secondly, think of the free time that it must have created. You're not wasting time, hours in a week, down at your local supermarket, going through that pain. So what are you going to spend it on? Well, that opens up the whole leisure industry to me. There's all kinds of stuff, whether you're sitting at home, signing up to more media stuff, or going out, traveling a lot more. This is now fueling all kinds of other things. And that's another big driver of commodities in some shape or form, whether you're eating more, drinking more, whether you're traveling, hence energy consumption, it's all a big boost. So I think it's going to be around for a while. But that sort of thing is very difficult to quantify because we're not fully out of the COVID environment yet.
Well, there is that sort of overused phrase, the new normal and so forth, which the extent of which, how much of it is going to remain new and how much we will habituate ourselves to
exactly
is a question ultimately yet to be resolved.
Yeah, definitely.
Thank you very much for your time today. Very good to speak with you. If you have any questions on any of the content that we've covered today, I'll be very happy to go through them with you. You'll have my details coming up in the next slide. Thanks very much.
Yeah, thank you, Will.